Value investing is a tried and true strategy that has been used by some of the most successful investors in history, such as Warren Buffett and Benjamin Graham. In this video, we will take a deep dive into the principles of value investing and show you how to identify undervalued stocks that have the potential for long-term growth. What is value investing? When it comes to investing, everyone wants to find the next big thing, the next Amazon or Apple. But what if I told you that the true secret to success in the stock market lies not in chasing after the shiny new tech companies, but in finding undervalued gems that have yet to be discovered by the masses? This is where the magic of value investing comes in. Value investing is an investment strategy that focuses on buying stocks that are undervalued by the market. It's all about finding companies that are being overlooked and underappreciated by the market, but have strong fundamentals and the potential for long-term growth. Think of it like a treasure hunt. You're looking for companies that have been buried under piles of junk stocks and overlooked by the market, but once uncovered, have the potential to be real gems. Value investors use a variety of metrics to determine a stock's true value, such as the price to earnings ratio and price to book ratio and price to book ratio. These metrics help investors identify stocks that are trading at a discount to their intrinsic value. But value investing is not just about finding a good deal. It's also about having patience and a long-term mindset. Value stocks can take longer to appreciate in value, and it's important for investors to have the patience to hold on to them for the long term. In short, value investing is a strategy that focuses on finding undervalued stocks with strong fundamentals and the potential for long-term growth, and it's a strategy that has been proven to be successful by some of the greatest investors in history. How to identify value stocks. So, you're convinced that value investing is the way to go, but how do you actually go about identifying those hidden gems in the stock market? Well, it's all about doing your homework and using the right metric. First and foremost, value investors typically look at a company's financials, including their income statement, balance sheet, and cash flow statement. This is where you'll find key metrics like the price to earnings ratio, P earnings ratio, and the price to book ratio, P BYU, and the price to book ratio, and the price to book ratio. The PA ratio compares a company's stock price to its earnings per share. A lower PA ratio generally indicates that a stock is undervalued, as it suggests that the company is trading at a lower price relative to its earnings. The PB ratio, on the other hand, compares a company's stock price to its book value, the value of the company's assets minus its liabilities. A lower PB ratio can indicate that a stock is undervalued, as it suggests that the company is trading at a lower price relative to its asset. But it's not just about these two metrics. Value investors also look at other factors such as the company's management, industry trends, and competitive landscape to get a well-rounded understanding of the company and its potential for long-term growth. It's also important to note that value investing isn't just about finding the stock with the lowest PI ratio or PEB ratio. It's about finding companies that are undervalued and have the potential for long-term growth, so make sure to do your due diligence and research the company thoroughly. Think of it like searching for a needle in a haystack. It might take some time and effort, but once you find that needle, it's worth it. And that's how you identify value stocks, by using the right metrics, conducting thorough research, and having patience and a long-term mindset. Risks and rewards of value investing. One risk of value investing is that a company's financial troubles may not be immediately visible. For example, a company may have a low PA ratio or PUP ratio, but it could also be facing financial difficulties that are not yet reflected in its stock price. This is why it's important to conduct thorough research and due diligence when identifying value stocks. Another risk is that a company's industry or sector may be facing headwinds that are not immediately apparent. For example, a company in the retail industry may appear to be undervalued, but if the entire retail industry is facing challenges, the stock may not perform well. Now, let's talk about the rewards. The potential rewards of value investing are higher returns and long-term growth. By identifying undervalued stocks with strong fundamentals, value investors have the opportunity to achieve higher returns than the overall market. Additionally, value investors often have a long-term mindset, which means they are more likely to hold on to their investments for the long term and wait for the market to realize the true value of the stock. This approach can lead to significant long-term growth. Research and due diligence. You can't just rely on a stock's PA ratio or PE ratio to make a decision. You need to dig deeper and get a well-rounded understanding of the company. Think of it like a detective story. You're the investigator, and it's your job to gather all the clues to figure out if a company is truly undervalued. One important step in your investigation is to review a company's financials, including its income statement, balance sheet, and cash flow statement. These documents will provide you with a wealth of information, including key metrics like the PI ratio and P ratio and P ratio, as well as insights into the company's revenue, expenses, and overall financial health. Another important step is to research the company's management team. A strong management team can make a big difference in a company's long-term success. Look for leadership with a track record of success and a clear vision for the company's future. Additionally, it's important to research the company's industry and competitive landscape. Are there any industry trends or challenges that could affect the company's performance? How does the company compare to its competitors in terms of revenue, market share, and overall financial health? Lastly, don't be afraid to ask for help. There are plenty of resources available, such as financial analysts and investment newsletters, that can provide valuable insights and analysis. Portfolio management? We'll get to that in a second. I have a favor to ask of you. If you like this video so far, please subscribe to the channel. You've done your research. You've identified a few undervalued stocks. Now what? It's time to think about portfolio management. Picture a jigsaw puzzle. Each piece represents one of your investments. To complete the puzzle and achieve your investment goals, you need to make sure all the pieces fit together perfectly. First and foremost, diversification is key. It's important to spread your investments across different sectors, industries, and even countries to minimize risk. By diversifying your portfolio, you'll be less affected by any one stock's performance. Another important aspect of portfolio management is risk management. Value investing is generally considered a lower risk strategy, but there are still risks involved. A good way to manage risk is to set stop-loss levels on your investment. This means that if a stock's price falls below a certain level, you'll automatically sell it to minimize your losses. It's also important to have a well-balanced portfolio. While value investing can be a great strategy, it's not the only one. Mixing value stocks with other types of investments, such as growth stocks or bonds, can help balance out your portfolio and reduce overall risk. Lastly, it's important to review and rebalance your portfolio regularly. As your investments grow and change, it's important to make sure your portfolio is still well balanced and aligned with your investment goals. Timing and patience. One key aspect of timing and patience is that value stocks can take longer to appreciate in value than other types of stocks. Unlike growth stocks, which often see rapid appreciation in value, value stocks may take several years before they reach their full potential. It's important to have a long-term mindset when it comes to value investing. Instead of focusing on short-term gains, focus on the long-term potential of the company and the stock. Another important aspect is to be patient and not to react to market fluctuations. The stock market can be unpredictable and volatile, but it's important to remember that the value of a stock is determined by the underlying fundamentals of the company. It's also important to have a plan and stick to it. Have a strategy in place and stick to it regardless of market fluctuations. This means not selling your stocks when the market is down, but instead hold on to them for the long term. Common mistakes to avoid. One common mistake is overvaluing a stock. Just because a stock has a low P ratio or P ratio doesn't mean it's a good deal. It's important to conduct thorough research and due diligence to make sure the stock is truly undervalued. Another mistake is buying into a value trap. A value trap is a stock that appears undervalued but is actually facing financial or operational challenges that are not immediately apparent. This is why it's important to research the company's management, industry trends, and competitive landscape to get a well-rounded understanding of the company and its potential for long-term growth. Another common mistake is not having a long-term mindset. As previously mentioned, value stocks can take longer to appreciate in value, and it's important to have the patience to hold on to them for the long term. Additionally, it's important to diversify your investments and not put all your eggs in one basket. Avoid putting too much of your portfolio in one stock or one sector, as it can be risky. By now, you should have a better understanding of the principles of value investing and how to identify undervalued stocks with the potential for long-term growth. We've discussed the importance of thorough research and due diligence, as well as portfolio management, diversification, and patience. We also talked about common mistakes to avoid and the potential rewards of higher returns and long-term growth. Think of it like a treasure map. We've provided you with the tools and knowledge to start your journey to uncovering hidden gems in the stock market. But remember, this is just the beginning. The real work starts now. It's important to do your own research and make your own investment decisions. Remember that past performance is not an indicator of future performance, and investing always carries some level of risk. In conclusion, value investing is a powerful strategy for finding hidden gems in the stock market. By using the right metrics, conducting thorough research and due diligence, and having patience, you can potentially achieve higher returns on your investment. With the knowledge you've gained from this video, it's time for you to start your treasure hunt and uncover hidden gems in the stock market.